Hey guys, we're live with George Coyle. So today there's so much going on. We got the election coming up. We have the market moving up and down, sideways, and frustrating the hell out of everybody, which is very normal pre-election stuff. We also have a lot of interesting things to kind of talk about with George today. So George, anything on your mind today that you've been thinking about
Yeah,
besides dudes eating light bulbs?
all kinds of things. Yeah. One of the big things I've been thinking about is just I think it was September 18th was the Fed meeting, like the actual release, right? Either way, 17th, 18th, I think was the meeting. And since then, bonds, I use the term bonds as a non-fixed income primarily person. I say bonds, and I mean to encompass like 10 years, 30 years, whatever. I'm not getting Fabozzi technical, but they've sold off a bunch since that day. And I think that's very interesting. And I'll weave this back into the election. But, if somebody had said, hey, the Fed's going to cut and they're going to cut more than expected, what do you think the bond market's going to do? The logical answer would be, well, it's going to go up, right? And I know that rate policy controls the short end of the curve, and that doesn't necessarily impact the longer term notes and bonds. But the fact that most notes and bonds have sold off pretty substantially, depending on which part of the curve you're looking at, is just very interesting to me because it's so counterintuitive, and it brings to mind that cliche, buy the rumor, sell the news. So somebody must have known, even though the cut was greater than the expectation, like presumably that event signaled something to someone and bonds started to sell off. And yeah, I don't know if you've been watching, but Stan Druckenmiller's been talking about his bond short a good amount lately. And you kind of think, well, by what logic would you put that trade on? I mean, as a trend follower, unless you're a very, very fast trend follower, you're probably long bonds from the move of the past few months and you're not going to sell it. So anyway, I thought that's kind of interesting. And the reason I've been thinking about that is just put it in the context of the election, right? The expectation is that, well, we know in 2016 when Trump got elected, the stock market went on an amazing 4-year run. So presumably, logically, Trump is really good for stocks. And Harris, she might have an unrealized gains tax and just decimate capitalism everywhere. So she's terrible for it. But as I think about the bond market, I start to think, well, what does happen on those election outcomes? The expectation is clear. Trump stock's good, Harris stock's bad, but will the stock market respond like the bond market did to the greater than expected rate cut to one of these outcomes? And I don't know the answer. Nobody knows the answer, but it's just something I've been thinking about. Maybe last week we were talking about all the decision nodes you need to make to get an election outcome right from an investment standpoint. And it's just another one, it's kind of that, is it priced in? But that's one thing I've been thinking about, and I don't have any intention of trying to trade it. But I'm sort of morbidly curious to see how it plays out. You're muted, or your microphone. Uh-oh.
Can you hear me now?
I can, yeah.
Okay, I have no idea what happened there. But anyways, I wrote a post about this a few weeks back, which is the Fed made a mistake was the name of the post. And so basically what I'm trying to say there, one, I'm trying to make a clickbait topic. So title is not exactly that I think the Fed made a mistake. It's the fact that when the bond market starts to call bluff, which it does this all the time. If you go back to 2018, it happened. Basically, they were raising rates and bond prices were moving up with them raising rates. So this was at the bottom is November 2018. Markets crashing every day. The Fed's continuing to raise rates. Bond market starts to move up with it. All the way straight through when he still continued to raise rates even in through December. So it was a lot of the Fed was basically behind the curve the entire time. And then now we're here in this part of the cycle, and the bond market is starting to move higher. the bond market moved higher for a little bit, and then the Fed finally came in and they said, "Hey, we're going to lower rates." And then the day they started lowering rates was the day that the bond market topped, literally at the same exact time, which is very interesting. I haven't ever seen it on the first cut or the first hike. I've only seen it later in the cycle, so it's kind of interesting that that happened so early. But usually that means they're close to moving the other direction, which would be wildly um, be very hard for market participants to grasp. Because if you're a market participant and you've been thinking, okay, well, the Fed's lowering rates, they're going to continue to do this for a year probably, and this is going to be great for me and the economy and so on, it's probably going to stop here. I'm saying that, yes, they're going to probably come in and cut again in November. Maybe they cut again in December. But I think at some point they're going to have to go, okay, well, the bond market is moving like this, which probably means, and what I think it's trying to signal, and once again, it could be, like you said, it could be some form of manipulation. Once again, we're not in the prediction business, we're in the business of making money, but it's good. It's a good thing to discuss. I just think that they would come in, and I think the thing is that the bond market is smelling that inflation is probably still out there. And the more that they cut, the more inflation is going to come back, and the bond market is kind of saying that. But once again, I do see that there's a lot of people on the other side of the trade. I see that there's a lot of people shorting bonds and selling bonds. Kevin Muir was on the show recently, the macro tourist, and he had the same idea where it was, hey, I think bonds are more of a short, and this is right when all the signals started in the first place. And he said, I think bonds are more of a short here than a long here. So I think that there's a couple different ways to look at it. I think Druckenmiller's idea and the way he explained it was very spot on, which is I just think it's premature, even though it's needed. Like, so it's premature if you look at just inflation. If you look at the economy, it's needed for them to cut rates. So it's going to be it's the problem with inflation. Like, you can't just will it away. You can't just say, hey, we're going to keep rates steady or we're going to raise rates or whatever. It seems like if you look at history, it seems like there's really no control over inflation.
Have you seen this comedian named Pat Bircher or something like that? He's got this great bit. He's always talking about the economy. And he's like, we created everything. And so why does it suck? And he's like, oh, they're going to have to print more dollars. That creates inflation. He says, let's just say it doesn't. You got to watch it. Quick aside. I'll send you a link to it. But anyway, yeah, I don't know. I mean, it'll be interesting to see what happens next week. So another thing, should I shift gears here?
No, whatever you want to talk about.
Yeah, I saw some post, I think it was on LinkedIn, and a guy was saying, like, here are all the strategists at the big banks and big, well-known independent research firms, and here are their S&P 500 end-of-year targets, and here's where they are proximity-wise. And I thought about it for a second. I just thought that's interesting because every year these guys, their S&P 500 target, it's a big game. You got to come out with one if you're a strategist. But realistically, like, I don't think I've ever met a trader, market wizard, whatever you want to call them, who's like, my end of year S&P 500 target is this. And I just thought it was an interesting point. Maybe there is one. I don't know if you know of one, but for the most part, I don't think that the guys managing the money think in terms of, here's my end of year target on this market or that market. And obviously it's like a necessity as a strategist. And I think a lot of times, when you start out, you're going to watch CNBC and you're going to see these people and they tell you stuff and it sounds like it has to make sense. And then you look at the markets and it's like, by what logical reason would you short the bond market after a greater than expected rate cut? And the answer is there isn't one, but it happens. So I think it speaks a lot to the dichotomy between what it takes to be a successful money manager and what it takes to be, a talking head, a market strategist, things of that nature. And we were talking a little bit about this offline, and it seems like they're just different roles. And ironically, like, the key, if there is one key to being a great trader is probably that you need to cut your losses. You need to have a point where you say, this didn't work and I'm not going to die on the mountain. But if you try to do that as a strategist, it's tough. We don't want to listen to the guy who has weak conviction or says, well, I think that this market's going to grow by AI, whatever. It's going to have a 25% CAGR for the next 10 years, but whoops, the stock just went down 10%, so I dropped it. It's not logically consistent to the masses to say that. So the strategists kind of have to take that point of view, argue one side, die on the mountain. And anyway, I just think it's like an interesting dichotomy that traders maybe understand, but a lot of people may not. So that's another thing I've been thinking about lately.
No, that is it's a good point. I think there's such a difference between being an analyst and a trader. Like an analyst can always come in and just say, "Hey, the S&P 500." Like today, I could say, "I believe the S&P 500 will be higher by the end of the year." Sounds cool. What does it really matter as a trader? I mean, sure, it could be good or could be up 1% by year end. Who cares? But you're right as an analyst, and you get to say, "Hey, look how right I am on my resume. I got this call right." And really, the thing, it's the reason why there's a lot of people who can paper trade and make money. There's a lot of people who can paper trade and make money, but there's very few people who can trade with real money and make money. Because it's a different thing on your psychology. Your brain looks at it differently. Your humans are wired to avoid loss. We're wired to avoid risk and avoid loss. In the wild, that would have meant we're hurt. We're going to die alone in the middle and probably get eaten by a lion or a bear or, coyotes, whatever it is, wherever you're at in the world, you could die like that. So we always just avoid loss. So that's why it's hard to be an actual trader. But if you're just calling things out and there's no real risk to you besides people being like, "Oh, great call, man. Look at his conviction." That's the thing that drives me crazy. The word conviction. He has so much conviction in a trade. What the hell does that mean to a real trader? It means nothing to somebody who's actually a real trader. You shouldn't have full conviction in any trade. You shouldn't talk about being as an analyst, it sounds really cool to say words like "I'm irresponsibly long," that Raw Paul guy. He always talks about being irresponsibly long. Sounds cool. It gets people, the retail investor, motivated to sign on to your product and so on. But does it really have anything to do with making money? And the answer is no. And that's why I think a lot of people are, led so many wrong directions as a trader. You start trading, you get into it, you hear somebody make a call and they go, "Hey man, look at this guy, how right he was. He said cocoa would go up and it went up." Yes, if I go in and I say 20 different things will go up, one of them will probably go up. And then I can post that one over and over again and tell everybody about call options on it and how I killed it. That's what a lot of people do. These guys never post their actual trades, their actual returns, anything like that. They just post, "Hey, look how great I'm doing all the time. Look at this great call I did. You're an idiot for not buying into this call and not subscribing to me because you would have also been involved in it and made $1 billion as well." And that's important. It creates urgency. I understand the marketing side of it. Just for people who are trying to learn how to trade, though, it's not going to help you make money.
Lots of thoughts on all that. One, I think the investment research business is really the media business masquerading as the investment business. It's not the investment business. They're just different. But conviction sells, right? And if you go out and you say, "Well, listen, the thing you need to be convinced of, or you have to have strong conviction in, is cut your losses," what a snoozer.
Yeah.
I mean, I'm saying it's about cutting your losses and it's about understanding this and price action. And somebody else is just buy Apple at this price and hold it and sell it here. And, then it's just a relentless bombardment of information that supports that narrative or narrative that supports the position, I should say. Martin Zweig had a great quote where he's like, "You can always find some information to support a bullish or a bearish thesis. And how do you deal with that?" Right. And his way was, trend following, stop losses, things of that nature. But yeah, I think a lot of it relates to uncertainty. There's a book called Future Babble by a guy named Dan Gardner, and it's probably the best recipe I've ever seen on potentially building a successful research business. And really what it's about is like, people hate uncertainty. We all hate uncertainty. We want to know that the future is going to be okay. So even if some person comes out and tells us a prediction and it's wrong, like, we don't really care because they've satisfied our need for a solution to uncertainty. It's funny, like when I worked on Wall Street proper, analysts would sometimes call and be like, I'm pounding the table on this stock. And it usually was a stock that was down. They wanted it to go up. And they'd say, I'm pounding the table. And none of this stuff changes. It's so funny how, like, you read these old books and you're like, oh my God, they say the same stuff. And so Jack Dreyfus, he was, excuse me, Druckenmiller ended up working for his company, and he was the best mutual fund manager for about 10 years. And Bill O'Neill actually studied him too, because he said he was, like, by a factor of 2, the best mutual fund manager. And O'Neill said he looked at all the stocks they bought and he found every single one of them was at a new high. But anyway, in his biography, his autobiography, Dreyfus's, which he wrote toward the end of his life, he talked about pounding the table. And he's like, when I hear pounding the table, I just run the other way. And he talked about how, he's like, he and his research analysts were too shy to talk to management. And he's like, but maybe that was a benefit because they had to make their independent decision. So, yeah, I don't know. All these terms too, it's like, what's a trader? Is it like a guy clicking all day, or is it a trend follower who's doing weekly signals? You have to get specific with definitions. And one other thing came to mind on the conviction. I was reading Black Edge, which is like an 8-year-old book about basically SAC leading up to when they became 0.72. And they had a conviction scale, but it was sort of like the analysts per the book, is your conviction 10? And that meant, like, I am 100% convinced of this. But a lot of those guys we know now had inside information that they used to have that conviction. So I guess it's just, all these terms need precise definitions, but backing up to the higher level, I think there's just a huge disconnect between what it takes to be a successful money manager, a successful strategist, and maybe, for that matter, a successful marketer of a money manager. And oftentimes they're sort of at odds with each other. And I guess the best example would be the trader cuts his losses and says, I'm not going to die on the mountain. And the strategist almost has to, or we're like, that guy has no conviction. Why should I listen to him? He doesn't know what he's doing. So it's to a lot of people, it may not be new, but to me, it's always interesting because it's just like, this is how things actually work, as opposed to how we think they might work. So
that's what's important about these discussions, which is we're talking all the time. And like, it's what I'm always trying to do on my channel is like, yes, I would love to. I understand marketing very well. So do you. We could both get on there every single day and tell everybody how much conviction we have in things and say, I'm pounding the table. Hell, I bet, I should just make a separate Substack just called Pounding the Table. I bet people would subscribe to it. As ridiculous as that sounds, it's true because people love that stuff. If I'm ever on like one of those spaces where there's like 1 million people on there, I'll hear people say all the time, oh man, I love that guy. Yeah, he gets a lot of stuff wrong, but like, I love his conviction. He's pounding the table. He has so much conviction on his things. Like, it's okay if you get it wrong. And it's like, yeah, we all get stuff wrong, but there's a difference with being like, and that's a thing that's an interesting segue into something we could talk about, which is if you're wrong small, like as a real trader, you just have to be wrong small. That's all it is. It's not that you're right, wrong, and you don't even think about it right or wrong. I don't think about it right or wrong anymore. I just think about it. If I'm losing small. And then like if you're a strategist or you're a person just writing and posting things, the difference is they're wrong big. And wrong big and losing money in a big way, that's something that wipes your account out. So this is the reason why like all these people are like, man, I was following this guy and like I got everything wrong and I lost all this money. It's like, yeah, because you can't sit there in like a trade that goes from 100 to 50 and be like, I still have so much conviction in it. There's no real trader on earth who would hang on to that trade. There's no signal that would keep you in it. There's no stop loss that wouldn't hit. There's no sell signal that you wouldn't get an exit signal for. So because of all those things, all of us would be out of the trade. But then we look wishy. Like people have said this to me all the time, all these years of trading, which is it looks wishy-washy. I've heard that term so many times. This person just changes his mind with the wind, and it's like, no, it's when the evidence changes, you change. When you get when my price action signals change, I change. And it's as simple as that.
Yeah, I think it ain't easy.
It
Kermit
ain't
the
easy.
Frog, right? Another thing I guess I've been thinking about is like take copper, for example. The fundamental thesis there is pretty biased toward the positive, and if you read like what the executives say, I do a lot of that, and all that stuff, you kind of come up with, okay, so we're going to migrate to this electrification of vehicles of pretty much everything, and especially for vehicles, there's going to have to be charging stations because these cars don't go that far, and maybe a couple percent of the potential needed for charging stations. So let's say we need 100. We've got like 5 of those in the world today, at least in the United States, was the last data I read. So it's like, oh my God, all these things are going to take copper. Copper is going to go to the moon, right? And what a great theory. And then you kind of look at the copper market and it's like, okay, since arguably the trend is up if you look back a couple years, but it's like it went from, let me just look here. In COVID, it went from 2 to 5 to 4 to 5 to 3 to 5 to 4. And it's this gigantic yo-yo. And I guess the guys who are going to make the most money, assuming the thesis plays out, are going to be the ones who sit through and ride through all that. But it's like, I don't think any
50%
traders,
drawdowns.
right, like routinely, if not more. And I guess ultimately, when you look at that, I mean, that doesn't account for rolls or things like that, but it's just, I guess what I'm getting at is it's interesting how the markets actually work. You can have that bullish long-term fundamental thesis, and the guy who, as a strategist, is going to say, I've been telling you this for 6 years, but then the guy who bought and rolled futures contracts went broke. We were talking last week or the week before about that. I just think it's interesting, and I think that's where the sort of 4-letter word timing, I know it's not a 4-letter word, but everybody hates it, comes into play. And you find that, like, that's another thing, right? The talking heads say, no, you don't time the market. It's time in the market, not timing the market. But then all the great guys use some form of timing. And so I guess it all rolls back up. I'm kind of on just a brain dump here, but it's the dichotomy between marketing, strategy, and trading. It's a very big difference. And I think it's just something that people should probably learn a lot about if they want to be successful in markets. So
No, absolutely. As I noticed, my computer's about to die. So 1 second.
sure.
Okay. So, but anyways, but yeah, I agree. I think it's especially copper. Copper is an interesting one because when you have, the story is the biggest undersupply in history. That's not exactly true. The most demand you're ever going to see in the coming years. Sure, that could be true. And the undersupply is a thing, it is real. But how do you can't just know something's just going to go up. And that's a really hard thing for, I think, a lot of people to understand in markets is like markets don't work like you think they should. Like if you think that because this story looks like this, that like for example, corn and wheat, soybeans, they have had the most bullish fundamental story I have ever seen in my entire life. Basically, if I have tried to go back and look at commodities and weather patterns and supply and demand stories, corn, soybeans, and wheat should probably be up 200, 300% from here. However, they're just kind of hovering around their all-time, well, not all-time lows, but multi-year lows, probably 5-year lows at this point. They're just hovering around those levels, and they're kind of maybe starting to bottom a little bit. But once again, the story looks great, but when do you buy it? That's the thing that's the difference between an analyst who can go, and I write this stuff I've been writing it all year. Hey, this looks really good. This has the best fundamental story. However, I have no reason to buy it yet. And I think a lot of people get confused by that, and they go, what is wrong with this guy? It has the best fundamental story ever, and he's not going to buy it. But that's that's trading, is understanding that just because it has a good story, just because the fundamentals make sense, just because other people might like the trade that you look up to, whatever it is, it doesn't mean that you just go buy the trade. It means that the trade could sit there for another year for no reason. You don't know when something will move. So I think the old Livermore quote, that's a good one, which is, waiting for the market to prove itself through price action. When you start to see those price action signals hit, if it starts to back up your conviction, and then you can get into the trade. But just getting into the trade because you think the market should do something is an absolutely ridiculous thing that only an analyst would say.
Yeah, no, it's true, right? And then right, wait for the price of the market to confirm your opinion.
Yes.
And markets are never wrong, right? Opinions often are.
Mm-hmm.
And I think that's just such a salient point that you can't say enough. I mean, it's just probably the most important thing. And yet, if you go say that on TV, like, unless you're already a billionaire, they're going to be like, "What's this idiot talking about?" It's so yeah. I guess those three parts back to trading, marketing, and strategisting. They're just very different animals, different skill sets. Even though you'd think they wouldn't be, right? But they are. So yeah.
You would think it's all the same, right? Like you would think that's the thing. Well, not for us, but new traders think it's all very similar. So if you're in a situation where you have just started a trade, you're just learning about markets, you're reading Market Wizards, you're reading, the Reminiscences of a Stock Operator, and then you come to, the big money's in the big swing, and then you go out and you see an analyst say, "Hey, copper's going to go to $10 easily because of the undersupply." This story, that story, and the other story, you might go, "Hey, maybe it's probably time to buy some copper and probably hold on to it." So once again, there's so many. It's just part of, to me, the biggest thing about trading is the idea that it just takes time. Like, it takes a lot of time to really learn how to do this and make the mistakes. And risk management is the first thing people should learn, because then they have the time to make the mistakes. You don't have time to make mistakes if you have $0, and then you have no mistakes left. you're out of mistakes. You have to have money to make mistakes. I know that sounds counterintuitive to people, but you have money, you make mistakes, you learn from those mistakes. You learn from those mistakes because you lost money and you paid that tuition to the market. And then over time, you start to learn, hey, get out with a small loss. Get into, maybe I'm going to extend my time frame. You start to think, I mean, at least I did. And I know that many other people I've talked to have, when you first start trading, you go, okay, if I just bought NVIDIA yesterday in the middle of the day and it bounced 3% today and I had a call option on that, I would have made this amount of money. And so you think about, these 5-minute trades or these 20-minute trades, and you're like, if I made $100 a day, it'd be great. And then you realize that's impossible. And then you go, if I made $200 a day, that'd be great. And you realize that's impossible. Oh, if I just made $5,000 a month, and then you realize that's impossible. And so, what I'm saying is you start to learn all these lessons and go, okay, well, returns are lumpy. Sometimes some months I have these really big returns. Some months I have no returns. Some months I have negative returns. But as long as those negative months are small and my great months are big, I'm making money.
Yeah, I mean, that's certainly I wrote some post that you reposted it here long ago, but it was how Western culture, at least, is against good trading because of frequency, magnitude, all that stuff. We're getting close to 11, but something that I think would be good to talk about next week is, who should we listen to? I mean, as you're saying this, I'm thinking like, well, boy, like if I was new to the business, it'd be like, who should I pay attention to? Because there's so many people saying things that are just opposites, right? You've got Druckenmiller saying diversification is a terrible idea. I don't know why I'm always going back to him. And then you've got the trend followers saying diversification is the only thing, and Ray Dalio saying it's the greatest thing. And so you're kind of like, well, whatever, and this guy likes copper and that guy doesn't. And I think it's gotten even worse with X and with Substack and all these sources where anybody with a keyboard and the inclination can go and start belting out information, and they could just make shit up. I mean, they could just be like, yeah, I made $8,000 yesterday. And it doesn't take a lot of know-how to like doctor up a supposed statement and like add a couple zeros and a plus sign, right? So maybe a good topic, and feel free to
Well, even
chime
the
in.
other way they do it too is they take, 5 trades and call options, and then the one that wins, they post how much it won, and like they show that over and over again. And it's usually before they've even got out. So you don't know if like they got out at that point, if they made that amount of money. Like you don't know any of these things. So they're just screenshotting things and people read it and they go, that's the gospel. That's it. Like, look how good this guy is. And it's like, anybody can do that. There's everybody on earth has the capability of buying call options in 10 different things, and the one that takes off, screenshotting it. Anybody could do that.
It kind of gets to a semi-interesting point too. It's like in the who should we listen to, and not to open a can of worms, but maybe a teaser here is like, George Soros, greatest trader ever, next to Nancy Pelosi. But he ultimately, like, he had a great run for years. But I imagine if we could see their compound annual growth rate, or his family office's compound annual growth rate over the last 10 or 20 years, we'd be kind of like, whatever, it's great. It's the S&P or something like it. And some of that's because he changed his risk, and some of it's because other people were running it. But I think it's just an interesting point, and I don't know that there's a solid answer, but it's like, who should we pay attention to? I've noticed some sort of legends recently, and like, I don't want to name any names, but I just noticed the track records that were from long ago are not what they are anymore. And you just kind of look at that and you say like, well, geez, like, it's not like a 2-year thing where there's a lull. It's like the period that we focus on is shorter than the period, the positive period that we focus on might be like half or less of what's happened after that hasn't gone very well. And so it sort of points back to these legendary windows, I think, are just such a function of a good time, the right person, the right place, the right time, the right risk appetite. Preferably you're younger, so you haven't lost money to the point that you're like, oh, I got to be careful because things can go really poorly. And all those things kind of combine. But anyway, I guess it's interesting to kind of think of all that and say, who should you listen to? And there's probably no right answer, but I think it'd be a fun topic to consider.
No, I like it. And it is a good topic. And I really do think it comes to a simple thing that we can end on is just, it comes down to who's transparent with their strategy, who's someone who you can see when they're buying and selling things, who's someone who I can learn from. I think that's the biggest thing, because at the end of the day, like, you just got to be your own trader. You can't follow somebody fully, and that, I know that, but that's something a lot of new traders think, like they're going to follow somebody and they're going to be great. And really the answer is, you want to find somebody that you can learn from, watch their discipline. And I always tell people, what I'm giving you guys isn't showing you how great of a trader I am. What I feel like I really give my clients on the newsletter is the ability to see like what I do when things aren't working properly. Like when I'm not making money, like what do I do? Do I panic? Do I sell everything? Do I run for the hills? Or do I just keep running my strategy and go, yep, this is a choppy period, it happens. And so like, I think that's more important, the ability to find somebody that you can learn from. But we could dive into that because that's a loaded topic. So let's dive into it next week.
And one last thing, if you don't mind.
Yeah,
I
go
think
ahead.
I'm going to start a book club, probably without video so other people can participate, but just suggest like, okay, let's read one chapter this week of Livermore's book or whatever, and then chat about it. So if people are interested, thank you. But there's my at GFC4. Send me a message on X and let me know if you want to participate, because it'd probably be better if other people shared their point of view as opposed to me just filibustering on what I think. One thing I have noticed is you read these books and different people perceive things in different ways. So I think it would be interesting to kind of cross-examine that to become collectively better. So if you're interested, send me a message or get in touch somehow. So
no, Love it. All right, guys. We'll see you soon.